All right, let's move on to example number 26. An entity recognizes a liability of rupees 100 for gratuity and leave encashment expenses. All right, so as an entity has recognized the provision for gratuity and leave encashment of rupees 100. For tax purposes, any amount with regards to gratuity and leave encashment will not be deductible until the entity pays the same. What they're saying is, until you actually pay the same in the form of cash, it is not going to be allowed as a deduction. It will be allowed as a deduction only when the entity pays it in the form of cash. All right, so provision is actually not going to be allowed as a deduction. The tax rate is 25%. All right, the question would basically be calculate the deferred tax impact on this. Remember, this is a liability, all right? Provision for gratuity is basically a liability for expenses to be paid in future. All right, so we start with step number one, which is carrying amount of provision. All right, what is the carrying amount of provision? And remember, I am doing all the calculations at the end of year one. I'm doing all the calculations at the end of year one. Carrying amount of the provision is given as rupees 100. All right, we have made a provision for gratuity and leave encashment of rupees 100. The second step is we are required to calculate the tax base of this provision. Now remember, the tax base of a liability, this is a liability, provision is a liability, is the carrying amount less the amount that will be allowed as a deduction in future. Tax base is going to be equal to carrying amount less the amount that is going to be allowed as a deduction in future for tax purposes. All right, so carrying amount minus future deduction for tax purposes. Now the carrying amount is actually nothing but 100. The carrying amount is actually equal to 100. What is the future deduction that I'm going to get for tax purposes? The question mentioned that these expenses are actually deductible on payment basis. These expenses are going to be allowed as a deduction on payment basis. Therefore, when I actually pay this gratuity amount in future, I will get a deduction in tax calculation of rupees 100. Whenever I make the payment in future, I will get a deduction of rupees 100. Therefore, the amount that is going to be deductible in future for tax purposes will actually be equal to 100 itself. All right. What is the amount of future deduction that I'm going to get for tax purposes? It's going to be 100 whenever I actually make the payment. All right. Therefore, tax base is actually going to be equal to 0. Tax base is going to be equal to 0. Therefore, step number 3 will be calculating the temporary difference. What is the temporary difference? Temporary difference will be equal to carrying amount minus the tax base, which is going to be equal to rupees 100 again. Now, how do we interpret? How do we interpret this? Carrying amount basically represents, in case of a liability, remember the interpretation is going to be based on the liability interpretation because provision for gratuity is a liability account. This 100 rupees represents the amount of outflow that I'm going to have in future. The 100 rupees represents the amount of outflow that I will actually have in future. Out of that outflow, out of the outflow of 100 that I will have in future, 0 has been allowed as a deduction. What has been allowed as a deduction so far is actually 0. Therefore, the amount that will be allowed as a deduction in future is actually equal to 100. The amount that is going to be allowed in future as a deduction is going to be equal to 100. All right. So because this is going to be deductible in future, the temporary difference is going to be, the nature will be deductible temporary difference. All right. Because this represents a deduction that I will get in future, the nature is going to be deductible temporary difference. Another way of looking at it also, if you remember, what I said is temporary difference is carrying amount less tax base. This tax base is nothing but again carrying amount minus future deduction. All right, this tax base was calculated as carrying amount minus future deduction. So if you look at it, this carrying amount and this carrying amount are getting nullified, and therefore temporary difference represents future deduction. Temporary difference would usually represent the amount of deduction that I'm going to get in future. All right, temporary difference would usually, in case of a liability, for a liability account, the temporary difference usually represents the amount that is going to be allowed as a deduction in future. So basically, in case of a liability, 99% of the times you're only going to see deductible temporary differences. You're only going to see deductible temporary differences 99% of the times. In 1% corner cases, you may also have taxable temporary differences. All right, but generally it will always be a deductible temporary difference. If it is a deductible temporary difference, we are going to have a deferred tax asset because I am going to get a deduction in future that is basically a benefit to me, that is going to be a benefit to me. Therefore, I recognize deferred tax asset at, let us say, I think the question mentioned 25% to be the tax rate. The question has mentioned 25% to be the tax rate. So I calculate deferred tax at 25 percentage. So deferred tax will be equal to rupees 25 for the first year. Change in DTA will also be equal to rupees 25. All right. So change in DTA will also be equal to rupees 25. What is the journal entry for this? I basically debit DTA. I need to recognize a deferred tax asset of rupees 25 in my books of accounts, and therefore I credit deferred tax benefit. I'm going to credit deferred tax benefit in the P&L account. All right. So I'm going to debit DTA and credit deferred tax benefit. This is how we are going to account for the deferred tax in year one. In year two, let us say if this is actually going to be paid off. In year two, if this is going to be paid off, then carrying amount will become zero because once it is paid, my liability will become equal to zero. The tax base would also be equal to zero, and therefore the DTA that we recognized in year one will be reversed in year two. The DTA that we have recognized in year one will be reversed in year two once the 100 rupees payment is actually made. All right, so this question actually is exactly the same as example 12 that we did. Under example 12 also, instead of just saying gratuity and leave encashment, they had given us just accrued expenses. All right, it's exactly the same as that of example number 12. If you think of it over here also, there's going to be a violation of the matching concept principle. How is there going to be a violation of the matching concept principle? This 100 of expense would have been recognized in year one in the books of accounts, but the associated benefit would actually be coming in year two. The associated benefit will actually be coming in year two upon payment of that rupees 100. Therefore, by recognizing the deferred tax in the current year, by recognizing the deferred tax benefit in year one itself, we are basically adhering to the matching principle concept. All right, we're adhering to the matching concept principle. All right, so that is with regards to example number 26. Let us actually quickly go through the institute solution. The tax base of the liability is zero. Carrying amount of 100 less amount that will be deductible in future is going to be basically equal to zero. 100 minus 100 is going to be equal to zero. In settling the liability for its carrying amount, the entity will basically reduce its future taxable profit by an amount of 100. When the entity actually settles this gratuity, my future taxable profit will reduce by 100 because this amount will be allowed as a deduction in future, and therefore the future tax payments will be reduced. The future tax payments are going to reduce by rupees 25, and therefore we are going to have a deductible temporary difference of 100 on which we are creating a deferred tax asset of rupees 25. So that is with regards to example number 26.